Hi everyone. The purpose of this video is to go over some of the extra content that I wasn't able to get to from Chapter 3. So because of the time constraints of this screen recorder, I'm only going to be able to record 15 minutes at a time. So I'm hoping that we can get through this in about 2 videos. So for the first one, we're going to go over posting adjusting entries to the trial balance. So these are all located in Chapter 3 of your book. There are 6 entries, A, B, C, D, E, and F, that we're going to go over. So some of these I'm going to breeze through because we went over them in tutoring, but there are a couple harder ones that I will discuss more. So this first one is prepaid insurance. You can kind of read the steps over here that they follow. But basically, we are buying a 24-month insurance package for $2,400. So using these numbers, if you take 2,400 divided by 24 months, that means we're paying $100 a month for this insurance policy. So we can see over here when we record it, when we buy it on December 1st, 2017, we're going to record a $2,400 prepaid insurance debit and credit cash for $2,400. These are both assets, so this transaction, we're trading our money for a prepaid insurance policy. So because this insurance policy begins on December 1st, 2017, the 24 months that the policy covers, it's going to be 1 month in 2017 because it doesn't start till December 1st, and then 12 months in 2018, and then the last 11 months would be in 2019. So we need to record these expenses in the proper years and not just in the year that we recorded. So in order to record the expense at the end of 2017, and remember we've only exhausted 1 month of the insurance policy, so that would be $100. The journal entry is going to be debit insurance expense for $100 and credit prepaid insurance for $100. Down here on the bottom, this is just a helpful way to show you where these are going to, the different T accounts. So prepaid insurance, you can see we had a $2,400 debit, which it's an asset, so it's a normal balance. And then on December 31st, we expensed off $100 worth of that. So our ending balance is $2,300. And then over here, the insurance expense is a debit of $100 because expense accounts have a debit normal balance. The next one, adjustment B, is supplies. So fast forward, purchased $9,720 of supplies in December, some of which were used during that same month. When financial statements are prepared at December 31st, the cost of supplies used during December must be expensed. So, at the end of the year, companies usually will do a physical inventory. So, when this company did a physical inventory count at the end of the year, there was $8,670 worth of supplies left. So, in order to get the amount of expense for the year, we need to take the amount they bought, which was $9,720, and subtract off how much is left. This gives us the amount that was used during December. So that difference there is $1,050. So the entry for this would be supplies expense, debit, $1,050, and credit supplies for $1,050. So you can see that this amount here was that amount they had on the last slide. I think it was $9,720 is how much was purchased, and we used that much. So because supplies is an asset, it has a debit normal balance. So when we buy supplies, it increases, so we debit it, and then when we use supplies, we credit it. So at the end of the year, the supplies balance is this amount here, $8,670. And then the expense, again, debit normal balance. Adjustment C. They purchased equipment for $26,000. The equipment is expected to have a useful life of 5 years and to be worth $8,000 at the end of the year. So this means that $8,000, another word for that is salvage value. So what we have to do in order to calculate the depreciation is take how much you bought it for, 26,000, and subtract off the salvage value of 8,000, so that we get 18,000. This is the depreciable cost. So this means that of the original asset, we have to depreciate it $18,000 until it arrives at its final salvage value of $8,000. The method that they use here is straight line, which just means that of the $18,000 depreciable cost, or the amount that we're going to depreciate, we're going to expense that on a straight line throughout its 5-year useful life. So some companies do it by year, some do it by month. So in this case, they are doing it by month. So there are 60 months in 5 years. So we take that $18,000 net cost and divide it by 60 months. This means that every month our asset is depreciating $300 based on our straight line method. There are other methods, and I'm not sure when it will be covered in this course, but straight line is the easiest to understand. So we bought it in early December, which means we need to depreciate 1 month's worth of depreciation. So as we got on the last slide, the monthly depreciation is $300. Because the asset was only in use for 1 month during the current year here, we need to depreciate the asset by 1 month's worth of depreciation. So in that case, we're going to debit depreciation expense because expenses have a debit normal balance, and we're going to credit accumulated depreciation for equipment. Remember, this is a contra asset account that is going to go right under the equipment account on the trial balance. So because it's a contra asset account, assets usually have a debit normal balance, but contra asset accounts have a credit balance of 300. So you can see here that where those two amounts go. Adjustment D. On December 26th, the client paid the $60 or 60-day fee in advance, covering the periods from December 27th to February 24th. So this is an unearned consulting revenue. So they received cash, $3,000 worth of cash, for consulting revenue that is going to be covering the next 60 days from December 26th. So because this was given on December 26th, we have to expense the amount that it covers in that current year, with the year ending December 31st. So if we do the math, the fee covers December 27th, 28th, 29th, 30th, and 31st. So that means it covers 5 of the 60 days. So down here, we can see that in order to figure out how much we need to expense, we need to multiply the revenue that we received, $3,000, and multiply that by the 5 days out of the 60 that take place in the current year ending December 31st. So 3,000 times 5 over 60 is $250. So we need to record this revenue, this 5 days worth of revenue, for the current year. So the journal entry for this would be, remember, revenues have a credit normal balance. So first thing we can do is the consulting revenue, credit it for $250. And then we can debit the unearned consulting revenue liability for $250. So down here, we can see where those amounts go. In the unearned consulting revenue, when we first received the money, we hadn't performed any of that consulting. So that whole $3,000 was a liability. But because we performed $250 worth, we debit that for a remaining liability of $2,750 after the current year. And then over here, we could see that consulting revenue is a credit normal balance. And I'm not sure if this is just for December or the whole year, but the balance of revenue at the end of the year that they made is $6,050. The next entry here is E. The employees earn $70 per day or $350 for a 5-day work week that lasts Monday to Friday. But from the real world, we know that pay periods don't always necessarily line up perfectly. So up here's the calendar from December. So we could see a pay period starts on the 1st, 15th, and 29th of December, and it lasts 2 weeks before they are paid on the 12th and 26th. So this is kind of what the information says down here. But as you can see, so they work Monday through Friday, Monday through Friday, Monday through Friday up here. However, when you get to the end of the year, we could see that the 29th, 30th, and 31st are Monday, Tuesday, Wednesday. However, the rest of their work week, Thursday and Friday, would be January 1st and 2nd. So this week is divided in between 2 different years. So we need to record the 3 days worth of wages that were performed in December at the year end here on the 31st. We cannot record, even though the January 1st and 2nd will be included in this pay period, because it is not in the same year, we cannot record the entire expense. So what we need to do is calculate how much salary was earned in December by the end of the year. So it says they make $70 a day, and there's 1, 2, 3 days. So we take 70 times 3, which is $210. We expense that $210 because expenses have a debit normal balance. And then we credit salaries payable because they've earned that salary, but we haven't yet paid it because it's going to be paid out in January after the fiscal year is up. Finally, the last adjustment we have here, F, has to do with accrued revenues. So these accrued revenues are earned but unrecorded because either the buyer has not yet paid for them or the seller has not yet billed the buyer. So in the second week of December, Fast Forward agreed to provide 30 days of consulting services to a fitness club for a fixed fee of $2,700, and they did the math, and that's $90 per day. They will provide the services from December 12, 2017 through January 10, 2018, or 30 days worth of service. The club agrees to pay Fast Forward $2,700 on January 10, 2018. So in this example, our company is going to be providing consulting services for 30 days, but instead of getting paid up front, we're going to get paid on the end. So at the end of because this overlaps a year, we need to record the amount that occurred in 2017, which was 20 days that have been recorded, 20 of the 30 days. So because of the revenue recognition principle, we must report that amount in the current 2017 year. So how we do that is by dividing 20 over 30 days, so 2/3 of the work has been performed, and multiplying that by the $2,700 revenue that we will receive. So that's $1,800 that we technically earned in the fiscal year 2017. So to record this, we would credit consulting revenue for $1,800 because it's a credit normal balance, and debit accounts receivable for $1,800 because we're going to be receiving that amount in the next period. So it's an accounts receivable, which is a asset. And you can kind of see where those amounts go down here. So this is for the 20 days. The rest of the 10 days will be recorded as revenue in 2018,